When you first look at a financial chart, it can seem like just a huge, jumbled mess of lines. But what if I told you there's a hidden language in all that chaos? Well, today we're going to decode that language. We're going to learn how to actually read the story the market is telling. So let's dive right in. So take a look at this. It's a total whirlwind of activity, isn't it? For most people, it's just, well, noise. So the big question is, how do you even begin to make sense of it all? How on earth do you find the signals in here that could help guide your decisions? Believe it or not, the secret to taming this chaos is actually pretty simple. It all starts with just one line. Seriously. This one humble tool, the trend line, is basically a Rosetta Stone. It's the key that unlocks the market's language, and it's the foundation for literally everything we're about to cover. And that one line leads us straight to our first huge concept, the market's invisible floor and ceiling. We're talking about the powerful ideas of support and resistance. Okay, so what is a trend line really? Well, think of it like a game of connect the dots for the market. You're just drawing a line between two or more significant price points. And by doing that, we can start to see the bigger picture, the direction the market is heading and where it might hit a wall or maybe find a safety net. Let's break those two ideas down. First, you've got support. This is like a price floor where buyers suddenly step in and say, okay, the price is right. It's a level where a falling price tends to find its footing and bounce. On the flip side, you have resistance. That's the ceiling, where sellers take over and say, whoa, not so fast. It's a point where a rising price often hits a snag. Honestly, the floor and ceiling analogy is a total game changer for understanding this. Just picture the price as a super bouncy ball inside a room. Support is the floor. Every time the ball hits it, it bounces back up. Resistance is the ceiling. When the ball hits that, it gets knocked back down. It's such a simple concept, but it's an incredibly powerful way to visualize the market's constant dance. So, what's actually making the ball bounce? It's not just some random lines on a chart. It's a battle of human psychology. As our source material points out, it all comes down to the traders. These levels, support and resistance, are the front lines in a constant tug of war between the bulls who want prices to go up and the bears who want them to go down. Support is where the bulls make their stand, and resistance is where the bears dig in. So, how can you start finding these levels for yourself? It's way easier than it looks, I promise. First, just scan the chart and find at least two major peaks or highs. Got them? Okay, now do the same for at least two major troughs or lows. Then, you just connect the peaks to draw your resistance line and connect the troughs for your support line. And boom! Just like that, you've drawn a price channel. You're already on your way to becoming a chart whisperer. All right, so you've got your channel. Now you can unlock the most important secret the chart has to tell you. Which way is this whole thing moving? We're talking about the overall trend direction. Turns out the market can only really move in three directions. First, there's a bullish trend. That's when the price keeps making higher highs and higher lows. It's a pretty clear sign that the buyers are in control. Then you've got a bearish trend with lower highs and lower lows, which tells you the sellers are in the driver's seat. And finally, there's a sideways trend, where the price is just bouncing between a flat floor and ceiling. That signals that the market just can't make up its mind. Okay, this next part is a really big deal, so listen up. Connecting 2 points is one thing, but to know you've found a real trend, you need to see the market prove it to you. We're looking for at least 3 touches of that trend line. That third touch is the magic number. It's the market's way of nodding and saying, yep, this trend is the real deal. Now, let's get ready to peel back another layer of this onion. It turns out that trends are kind of like Russian nesting dolls. They exist on different scales, all at the same time. This is a pretty mind-bending concept that comes to us from the legendary Dow theory. So, the famous Charles Dow gave us this brilliant way to think about it. He broke trends down into 3 sizes. You've got the primary trend, that's the big one, the long-term tide of the market. Then, riding on that tide are the secondary trends, which are like the waves. And on those waves, you've got the minor trends, the little day-to-day ripples that can feel like a big deal up close. So let's actually take a look. When we zoom way out on a chart, we can see that primary trend, nice and clear. See? This is the tide we were just talking about, that huge, big picture movement that sets the stage for everything else. Okay, now let's zoom in a little bit. You see that? That's a secondary trend. It's one of the waves riding on that bigger tide. It's a shorter-term move that might even go against the primary trend for a little while, kind of like a countercurrent in a big river. And if we zoom in one last time, we get down to the minor trend. These are the ripples on the waves, that daily noise. And just like that, you can see how the tide, the waves, and the ripples can all be happening at the very same time. It's this beautiful, chaotic dance, and a smart trader knows which rhythm they're dancing to. Now, wouldn't it be nice if the market always played by the rules? But come on, where's the fun in that? The market absolutely loves to throw curveballs. And that brings us to a super important warning. You have to beware of the dreaded false breakout. So you see it happen. The price smashes right through a key level, and your heart starts racing. You think, is this it? Is this the big move I've been waiting for? But hold on a sec. Does every single one of those breakouts actually mean a new trend is starting? Yeah, not so fast. Welcome to the world of the false breakout. It's the market's favorite head fake. This is when the price teases a breakout. It lures everyone in, only to snap right back into its old range like a stretched rubber band. It is a classic trap, and let me tell you, it's claimed more than a few victims. So, how do you keep from falling into this trap? Well, you have to become a trend detective. Look for clues that the current trend is running out of gas before the breakout even happens. For example, is a strong downtrend suddenly failing to make new lows? That's a huge red flag. And always remember our rule of three. Don't ever trust a new trend until it's proven itself with 3 confirmations. Wow. Okay, we've gone from a single, simple line to building out a full-blown market map. So now, let's talk about how to actually put that map to good use. So look at that. You now have a powerful new toolkit at your disposal. You can use Trendlines to bring order to the chaos. You get support and resistance to understand the market's floor and ceiling. You can identify the trend type to know who's in charge. You know how to use multiple time frames to get the full picture. And you know to always be wary of those false breakouts. Look, theory is great, but practice is where the real magic happens. The absolute best way to get good at this stuff is to just get your hands dirty. Open up a demo account and just start playing around. Draw your lines, spot your trends, identify those channels, and watch how the market moves, all without risking a single penny. It's the best way to build both your skills and your confidence. And so, that leaves us with a final question to think about. Is technical analysis some kind of crystal ball that can predict the future? Or is it something a little more grounded, maybe more useful? A really detailed map that just helps us better navigate the market's wild, ever-changing landscape. I'll leave you with that to ponder.